in this session, we will be speaking about which kind of patterns do we use. So this will be a very, very crucial session. So let's start by defining conventional patterns. So patterns that you already know about, because they're patterns that everybody knows they exist and is looking at them in the market. So for example, the head and shoulders pattern. Now, when you have a head and shoulders pattern, what do you have? So very simply, when you have a head and shoulders pattern, what you have is the market going to create a high, then the market makes a retracement. The market creates a higher high and then makes a retracement. However, as we know, once the market reached back to this zone, so basically coming from above, the market goes back inside of this area, then we have two things. We know that the market has created a higher high, so by definition the market is now in an uptrend, plus we also know that the previous resistance is supposed to become support. So what we know is that from this area the market is supposed to start the next impulse to the upside. However, this doesn't happen and the market breaks this area back below. Now there are two options that can happen at this point. The market can either go for a retest of this area, or as many times this is what happens, the market doesn't even reach this area. The market creates a right shoulder that is lower than the left shoulder, because this is the left shoulder, head and right shoulder. 90% of the times the right shoulder will be lower than the left shoulder. Now let's continue defining our conventional patterns. For example, you have a double top. The market makes an impulse, makes a retracement, and then goes to create another impulse. Now at this point we know that we expect the market to create a higher high. However, this doesn't happen and the market basically rejects aggressively this high. So basically creating a double top. Now what we expect is this low here to break. And this is what forms another of our basically patterns, but that is something we will speak about later. So this is basically what happens with a double top. We have a trending market, the market goes for an impulse to the upside, retraces, goes for the next impulse, but fails to break the high. So basically we expect the market to create a lower low, because once the market goes down, it creates a low that is lower than this low here. So by definition, a lower low. Let's define another key basic pattern. For example, we will be speaking about wedge formations. So basically, what is a wedge in the market? A wedge is any kind of consolidation in the market, and I know many people basically have tried to complicate things by defining many types of wedge formations. So basically you have ascending wedge, descending wedge, triangles, but we keep it as simple as possible. What you need to realize is that a wedge formation is when the market is not breaking in any specific direction. So basically the market is decelerating while it is moving, and it doesn't change if this happens to the upside, to the downside, or sideways, because this can happen in any way. You basically get a deceleration of the market. The market was impulsing with very nice waves, and the waves start getting smaller and smaller. I will draw this one a little bit better. So basically the market is moving to the upside, but then the market starts to create waves that are always smaller. And this is what you have with these patterns. The market basically is decelerating while it is moving. Now these formations here are not very common in the market, however they do exist. Now why do I say that people overcomplicate things? Because we already learned how to use trend lines, and at the end you can just take a trend line on these highs and a trend line on these lows, and these patterns in the end just turn out to be a simple break of a trend line, because in the end the market eventually will break either to the upside or to the downside. Now I will tell you what we usually do expect from these patterns. Usually if we have a pattern that is consolidating horizontally, we will expect the market to break it to either directions. We don't have a clear direction. Now if it is consolidating to the high, then what you are expecting is the market to break to the lows. If the market is basically making this correction to the high, what you're expecting is the market to impulse to the downside, so to break this trend line to the downside. If on the other side the market is losing its momentum to the downside, because this is just a loss of momentum in the market, if it is losing momentum to the downside, you expect the break to be to the upside. But anyway, this comes down to a simple break of a trend line, because in the end that is what happens. Now let's continue defining patterns. We have defined very conventional patterns that most people already know about. These are simple price action patterns. Now, continuing defining patterns, we will be speaking about M and W formations. Now, M and W formations work in this way. There are many different types of M and Ws. Let's start from the W formations. But the simple concept is this. It doesn't matter what kind of W formation it actually is. Every time you see a W formation, you are expecting a push to the downside. Every time you see an M formation, you're expecting a push to the upside. Very simple concept. When you have an M, you're expecting a push to the upside. When you have a W, you're expecting a push to the downside. And all that I'm speaking about it in this introduction section is just to define the basic concepts. You will understand later on how you're supposed to apply this. But now, this is just to really speak about the basics, because in this way you will be able to understand all the strategies. Now, let's speak about the M formation. The market goes to the high, goes to the low. Sorry, let's actually start from the W's. Now, there are many types of W's the market likes to create. The first type is the regular W. This is just a normal W formation. Let's make it a little bit lower here. The market goes down, up, down, up. Now, with this kind of formation, so basically what do you have with this kind of W here? Usually, with this W formation, the market goes to the high, makes an impulse to the downside, makes the retracement, it goes for another impulse. Now, this leg here can stop either with a higher low, so higher than this low, with an equal low, so basically creating a double bottom, which is the exact opposite of a double top. I didn't say it, but because it's kind of obvious, the M formation and also the head and shoulders have the exact same patterns, also reversed. So what I mean by this is that we can also have the inverse head and shoulders. That is the exact same concept, and we obviously have the double bottom, which is the exact same concept. Okay, exactly the same concepts. So here, with the W formations, you can have either, with the regular W, you can have either a higher low or an equal low. So basically a double bottom. And the market breaks the neckline. Now, what is the neckline? The neckline is this area here. This is the neckline of the W formation. And with a regular W, you're expecting price to hit more or less this region. Now, usually this region will actually be in confluence with the Fibonacci levels. What I mean by this is that if now the market is impulsing to the upside, you have already learned that you need to take your Fibonacci on this leg here, because this is the previous leg. So by taking your Fibonacci from this low to this high, most of the times the area in which the market will shift direction is usually the minus 0.618. But anyway, you don't really need to be accurate, because timing your entry will be done all over time frames. This is just patterns for direction on the higher time frames. And we also use these patterns to find entries on the 4-hour time frame. But at the moment, we're speaking about the W formation as an indication of direction. So for example, if you see a W formation on the weekly time frame, you know that we're expecting to get a weekly push to the downside. And at that point, we will go down on 4-hour time frame to find our entry. And we will learn how to do that in later on sessions where we will speak about the strategy itself. But now what you need to memorize basically is that if you have a W formation, then you're expecting this push to the downside. And you're expecting this push to the downside at least to the neckline. This is what you are expecting. Now, Sometimes this kind of W formation, I will tell you immediately the other type of W formation. This kind of W formation has basically another kind of form in which it presents itself. So basically what happens is that you have the exact same push, nice W formation, either a higher low or an equal low. The market breaks the neckline, but it doesn't shift inside of this area. So we just said that most of the times the shift to the neckline will happen inside of this area. So it's kind of a reversal zone. But sometimes it happens that this becomes an extended W. So this is a regular W when the market starts the push from here, and this is an extended W. And the concept is always the same. After the extended W, we are still expecting a push to the downside. But in this case, we're not expecting a push to the downside to the neckline. In this case, we're expecting a push to the downside to this high here, which most of the times will actually line up with the 382. Obviously, sometimes these retracements will actually continue all the way to the neckline. So overall, to keep things simplistic, also in this case, we are expecting a push to the neckline. So every time you see a W formation, you're expecting a push all the way to the neckline. Now continuing with W formations, we have now the bearish W. Now this is the only W formation in which the market doesn't break the neckline. And this is how it works. The market goes down, up, creates a lower low in this case, so not a higher low or an equal low, but a lower low. The market then goes for a retracement, and at this point we expect the next push to the downside. Now obviously this pattern is reminding you of another situation, because once you have this, you have actually a lot of confluence, because what do you have? You know that the market has already created a new low, so the market is in a downtrend. You know that the previous resistance here, the previous support here, sorry, is now supposed to become resistance. And around this area you expect the next push to the downside. And this is the bearish W. From here, you're expecting the push to the downside. It's a W formation. And in this case, what will be the target? Very simple. You already know that if now the market will start an impulse to the downside, to take your target, you need to take your Fibonacci on this retracement. So you will take your Fibonacci on this retracement, and you will identify your target 1 at the minus 27. So you're expecting in this case a push to this area. Very simple concept. Now let's continue with M formations. Now M formations is exactly the same concept, but is all reversed. I will go to it very quickly. Here a regular W formation, this will be a regular M formation, and you're expecting again a push to the neckline from this area. Also for M formations, as for W formations, you can have an extended M formation, and again, overall, we want to see a push to the neckline, even if we know that we have some resistance around this area. And again, you can have basically a bullish M formation, and you're expecting the next push to the upside, and the target will be given by taking your Fibonacci on, your Fibonacci on the previous leg, which is this one here. So these are the patterns in the market. We will now go on live market examples of these patterns, and we will find them. Now let's start by finding the first pattern that we defined. So head and shoulders and inverted head and shoulders. And let's see how many times we actually do identify them. So immediately we can see that we have a nice, now we're on the weekly, we will also go on the daily to identify more patterns, and we will be also switching pairs. Now the first one I see immediately in front of my eyes is this one here. The market goes up, down, creates an equal low, the market goes for a right shoulder. I will use the replay tool so it will be simpler for your eyes. The market created kind of an equal low, even if the market slipped all the way to here, but overall this was the left shoulder, this was the right shoulder, and this was the head. Now if you notice, the left shoulder is higher than the right shoulder. You're immediately able to see this, and it's very important. Now continue going. Let's see if we find other head and shoulders here in the weekly time frame. Not really. Let's go immediately to the daily time frame and see if on this pair we have other head and shoulders. If not, we will just switch pair and we will be looking for head and shoulders or another pair. Now head and shoulders formations are not that common on the daily time, or on basically higher time frames. Let's see if we get one. Not really on this pair. We're not really getting it on this pair. Let's go on Euro CHF. Just changing pair to see if I can find a clean one to show to you. Here it is. We have a nice inverted head and shoulders, but in this case the right shoulder was lower than the left shoulder. Sometimes it happens. It's not always like this, but most of the times the right shoulder will be higher. Now here you see the pattern. You see you have the left shoulder, the head, and the right shoulder. And obviously when you see the market creating this pattern, you expect a push to the upside. Now the question is, when do you know that you are expecting this pattern? Very simple. At this point you already know that you're expecting a head and shoulders. Why do I say this? Because if the market goes down, up, down, and creates an equal high, then at that point obviously you're expecting head and shoulders. If instead the market goes down, up, and doesn't make it to the high and starts the next impulse, then you're expecting a lower low. It's that simple. It's just simple market structure. The market creates an equal high, you're expecting a head and shoulders. And that is exactly what happened. Now let's continue and let's see if we find other examples. Here we have a minor one here. As you can see, we have a minor one here. So the market went to the high, low, higher high, didn't make it to basically create a higher low and continue to the upside, created an equal low. At that point we expected the head and shoulders, and in this particular case the right shoulder was in fact a little bit lower than the left shoulder. So right shoulder lower than left shoulder. Let's continue and see if we have other examples. However, I know that the concept is now clear, how you're supposed to spot a head and shoulders pattern. Maybe on the weekly we will get something clean. Actually, I do remember we have a very clean, here we have a very clean one, huge one actually in this case. The market goes up, down, creates an equal low. At this point you're expecting a head and shoulders. So you already know that the right shoulder is lower than the left one. And you also have another confluence. If you look, you have down, up, W formation. Again, you're expecting a push to the downside. Just wanted to show you this. However, let's stick to the head and shoulders. From this area you're expecting the market to push to the downside because the right shoulder is supposed to be lower than the left shoulder. And the market in fact did create this push to the downside. I already remember it because obviously we were trading this market. So let's continue going with our patterns, and let's speak about double tops and double bottoms. This is the second pattern we spoke about, double tops and double bottoms. These patterns will be a little bit harder to identify, but let's speak about double tops and double bottoms at the moment. Let's see how many we can actually spot. As you can see here, we immediately see one. The market went all the way up, went to the low, went again up. At this point we were expecting the market to continue to the upside and create a higher high. However, this never happened. The market just rejected very aggressively to the downside. So at this point you're expecting further continuation to the downside, but at that point you will have an affirmation and you're expecting the push to the upside, and that is exactly what happened. Now let's continue and see if we find more. As you can see here, we have a very nice double M formation. We will speak about this later. However, let's speak about double tops and double bottoms. Here we can see a nice double bottom, very clear to see it. The market went all the way to the downside, created a retracement to the previous resistance, previous support, now turn resistance. The market started the next impulse to the downside. However, the market failed to break the low, and we are now expecting the market to continue the push to the upside. And that is exactly what happened. At that point, you have an information, so you're expecting the retracement. Now, let's keep going, and let's see if we find other examples of double bottoms and double tops. Here you have another one. The market went all the way to this low, then went to the high. Actually, let's spot all the moves. The market went down, up, minor double bottom. Then the market, basically we have that from this low the market went up, down, and it failed to break this low, because as you can see, this candle went all the way down here, but then it closed back above this low here, so confirming that this is a double bottom. And at this point the market failed to break the low. We're expecting continuation to the upside. So the concept now should be quite clear. Let's continue with our patterns. So at the moment we spoke about most of the patterns. What we need to speak is about wedge formations. So let's go and speak about wedge formations. Let's identify these patterns in the market. Let's keep charts clean so it will be easier for your eyes. And let's see if we can find these formations that, as we said, are a little bit more rare. Now here we immediately see one. The market was stuck inside of this wedge formation. In this case, as you can see, is a wedge formation that is neutral, so we don't really know to which side the market will break it, but then it's clear that the market gaps up, breaks the trend line, goes for a retest, and continues the acceleration to the upside. Very simple to see this. Let's see if we can find more. Anyway, this should clear up things already. Again, here we have another wedge formation with already, let's actually go before it was, as soon as it broke, we had the market that was moving again in a neutral wedge. And why do we have so many neutral wedges? Because this is what happens when the market doesn't know to which direction it should go. So if the market doesn't know if it is in an uptrend, so basically big traders, banks and institutions are a little bit uncertain about a certain market, then what happens is that the market starts consolidation, and then the market starts the push, or they're just accumulating their positions. There are two reasons for which these formations happen. Now again, let's keep going. Here we can see a minor one. This is all I really wanted to show. Not really clear one, but anyway, the market is kind of moving in this parallel channel, but almost not really a wedge. This is kind of a channel, not really a wedge. But anyway, in the end, the point is that in the end, these patterns just turn out to be a simple break of a trend line, because you can create hundreds of patterns and name it in 100 different ways, but in the end it will always be a break of a trend line, a simple break of a trend line, either to the upside or to the downside. So anyway, you don't really need to memorize all these patterns that are based on trend lines, because in the end you will have a break of a trend line. So you just need to know how to draw a trend line and how to identify when a trend line is broke, so when the market closes above it. End of the story. But since we defined them, let's speak about them. Here you have very different price action. Let's see if we can get something a little bit clear. Okay, This will be the last example for these patterns, and we will move to W&F formations. I found a clear wedge. This is a clear ascending wedge. You can clearly see that the market is losing its momentum to the upside. The moves become almost basically keep getting smaller and smaller, and eventually the market pushes to the downside. Very simple concept. And again, you can see it also here, but to the upside. So basically the market is losing its momentum to the downside, and the pushes keep getting smaller and smaller, and at some point the market is ready to push to the upside. So let's keep going, and let's now speak about the formations that happen the most in the market. So W and M formations, and then we will be over with the session and basically the introduction as a whole, and we will be ready to dig inside of the real strategies and how to apply everything that you have learned inside of this introduction section to the strategies and to the market, to basically take live trades. Now we will be looking on basically many pairs, and we will be searching for W formations, these three kind of W's, and these three kind of M's. So starting here from the first chart we have in our hands, let's identify the patterns. A very simple one immediately goes in my eyes. Here we go, nice and clean W formation. The market goes down, up, down, breaks the neckline. At that point you're expecting a push at least to the neckline. Now let's speak about something. Most of the times the neckline, you don't have to consider the wicks. The wicks are not the neckline, especially when the wicks are this long. The real neckline, you have to go to the line chart, because if you go to the line chart, you just go here and switch from candles to line. The line chart will give you the closes. Now what do I mean by the closes? The market will give you when the bodies of the candles start, and that is the real structure area. So you're expecting a push to the neckline, which is the close of the candles. Basically you're expecting the market to hit the bodies of the candles. So this will be the neckline. And again, obviously these patterns have very high completion rate. Most of the times the market will hit these areas. And you can see now, I want to speak about this now because we have it straight inside of our face. Now you have an information, you're expecting the push to the neckline. Now if you see that the neckline is 128.99, now obviously you will never take this as your take profit, because we already learned in the previous session that basically 128.99 is not one of our strong numbers. Our strong number just above this number is 128.20, because we already learned that strong numbers are 20, 50, and 80. So 128.20. Now if you're asking yourself why I'm ignoring the last number, the last digit, is because you always have to do this, even with pairs that basically have prices, longer prices, like for example 0.6294. This 6 in the end, I will ignore it, because that is not a pip, that is a pipette. Basically the unit smaller than the pip, and most 5-digit brokers will give you this. Basically all 5-digit brokers will give you this, but it's not a pip, it's not relevant. We only need the first 2 digits in this case, and if you have a price in this form, you need the last 2 numbers, not basically not the last 6. So what I wanted to say is that if this is the neckline, then you need to take your take profit at the first strong number above this neckline, which will be 20. So 109.20. And as you can see, that is exactly what the market hit before starting the next push to the upside, which eventually failed. But as you can see, that would have been our take profit, hit perfectly. Again, we have here a nice another W formation. you have down, up, down, up. W formation, we're expecting a push at least to the neckline, and in this case the market also exceeded it. Now let's keep going with the analysis. Here you have a W formation that we didn't really speak about, but sometimes you can have a failed bearish W. We need to add this. Sometimes what you will get is a failed bearish W. What do I mean? The market goes down, up, down, up, but the market doesn't fails, basically creating the next push to the downside and goes all the way to the upside. At that point, again, you're expecting a push to the neckline. So overall, the simple way to remember all of this is just if you have W formation, expect a push to the downside. And if you have M formation, expect a push to the upside. Simplest way to remember this. And the same goes for the reverse pattern. So basically for a failed bearish bullish M. If this pattern fails and basically you get a push to the downside, then you expect a push to the neckline. And that is exactly what we see here. That is exactly what we see here. The market goes down, up, down, and the market fails to create a new low here and just accelerates to the upside, and then you're expecting a push to the neckline before the market continues to the upside. Now keep going, you have a nice M formation. The market starts here from this low, up, down, M formation, you're expecting a push to the upside. As you can see guys, these patterns have very high completion rate. Now think how powerful it can be. If you know that the market is supposed to make this push to the upside, you can go on lower time frames, aka the 4-hour time frame. For example, we always take our entries on the 4-hour time frame, and we will be monitoring the 4-hour time frame for all of our valid entries. And we will be speaking about entries in the when we will be speaking about the strategy. But anyway, how you're supposed to take your entries is the same way in which you're supposed to take direction, but you just need to add some things, because the patterns that we use for entry are the same as the ones that we use for direction, because the market respects them on all time frames, but we will use some more tricks just to be more accurate. Now keep going, let's find more patterns. You have up, down, obviously you're expecting a push to the neckline. That is exactly what you got. Down, down, up, down, boom, the market hit the neckline. Again, here you have an extended M to the downside. The market didn't retrace from this area, went all the way down, and then boom, the market went to the neckline. As you can see, M formation, push to the neckline. Now in this case, the market, as you can see, failed to go to the neckline. Sometimes it happens, but most of the times the market will succeed in going to the neckline. In this case, the market stopped. It didn't make it all the way to the neckline. But most of the times you will get the push to the neckline. As you can see, also here you have down, up, W formation. At some point the market shifts to the downside and goes all the way down, almost to the neckline. Now we can keep. Let's go, for example, on the daily time frame, and let's find more W and M formations on the daily time frame. But I think the concept is quite clear. As you can see here, we have a very clear M formation, but overall I know that the concept is clear. If you have an M, you're expecting a push to the upside. If you have a W, you're expecting a push to the downside. And anyway, you will see a lot of W and Ms when we will be speaking about the strategy itself. The strategies itself, the WM strategy. So this was just to show you what we're expecting when you see these patterns and how you're supposed to spot them. You have up, down, M formation, you're expecting a push at least to the neckline. Very simple and straightforward. So this is all. In the next sessions we will be speaking about the strategy itself, how you're supposed to take the entries, how you're supposed to take direction, and basically the different strategies that we use.